Hello guys, good morning, good afternoon, good evening, depending on where you are. My name is CPA Makan. Today I welcome you to the class of Financial Reporting and Analysis, intermediate level, that is CASNEP syllabus. So today I'll be discussing about IAS 21, that is International Accounting Standard 21, that is about foreign currency transactions. So today, welcome. Now, before I begin, let me just begin by giving out some possibilities of the meaning of the word foreign currency transactions. In most cases, when people form a company like in Kenya here, you form a company with an intention of doing a business with it. So for that matter, you might either do business in Kenya or do the business within East Africa, Africa, or international. For that case, people want actually the businesses to grow. If you trade in Kenya, we call it local transaction. If you trade between Kenya and other countries, whereby you go to other countries, you buy goods, you bring them into Kenya, you sell them, or you take goods from Kenya, you sell to other countries outside there, that is now becomes international. And for that matter, it means that your currency that you are using will be very determinant. That is to say, you have to know if, for example, you are selling goods to America, which currency are you selling the goods at? If you are selling goods to Uganda, what currency are you selling at? If you are buying goods from other countries into our country, what currency are you paying these goods? That transaction that relates to international trading is what I'm calling foreign currency transaction. The major challenge comes in when you are doing financial statements, when you are preparing financial statements. In this matter, there are three main things that one accountant should know, or any business person should know. Although business people don't prepare financial statements, but this is purely for the accountants, preparers. For if they are preparing this financial statement, there are challenges they are facing. Number one, if a company in Kenya, let's take for example Equity Bank. Equity has opened a branch in Tanzania. What will happen therefore, that company that has been opened in Tanzania as Equity will be independent. Therefore, it will be called independent in the sense that it has to operate based on the laws and regulations of Tanzania. So therefore, that particular Equity branch in Tanzania should do transaction based on the local currency. Correct? This local currency has to be converted into functional currency. That functional currency, I mean, this a currency in which the entity is operating with. For that matter, if it is Tanzanian shillings, so they have to be converted into Tanzania shillings. If it was trading in Tanzania using US dollars by selling goods and by actually exchanging money in terms of dollars, in terms of pounds, in terms of Tanzania, in terms of any nature of currency, what will happen therefore is that it has to be converted into Tanzanian currency. If it has been converted into Tanzanian currency, we call now that one as what? Functional currency. And because Equity has a headquarter in Kenya, so therefore Equity will have to prepare group accounts accommodating all the branches in Kenya, all the branches in Tanzania, all the branches in Uganda, all the branches in Rwanda, all the branches in South Sudan. All these have to be converted together to mean that the functional currencies are being translated into what we call presentation currency. And that is where the challenge comes in. That if the local currency or foreign currency or functional currency is not properly done, there will be an error when it comes to presentation currency. And that is why this particular topic is there, IAS 21. For that matter, let's see now examples. We can have a company like A. Company A is doing transactions. Okay? Company A is doing transactions. That is to say, it is buying goods, correct? Buying goods and selling them. When they are buying goods and selling them, it means that they are either dealing with two or more countries. For example, country A, that is for example Kenya, correct, buys goods from country B. correct? And these goods that have been bought from country B, it's in US dollars. In US what? Dollars. That is purchase. Immediately, Kenya Shillings has bought this particular items from B company in US dollars. Company A, that is Kenya now, will now buy the goods in US dollars. Once goods have been bought using US dollars, Kenya Shillings, this company A now will decide to sell. That is selling to company C using sterling pounds. You can see. So the Kenyan company is buying goods from company A, paying it at what? US dollars. Then the same company A is selling the same goods that have been bought from company B at pounds to company C. In this case, it means that this is the purchase and these are what? Sales. So this is what we call foreign transactions. Correct? And because the country is in Kenya, this selling and buying should be translated into what? Kenya shillings. Correct? So you can see what is happening. That you are buying using US dollars, then you are selling using pounds, then from there you have to prepare financial statements by incorporating the currency called what? Kenya shillings. So this is what they call foreign currency transactions. Another point about this area is that assuming we have company A, this company A has subsidiaries. This company A has subsidiaries. Like the example I've just given out about the Equity Bank opening a branch in Tanzania. Then we have also associates. These are companies that are actually under group accounts. We have also what we call a joint venture. Joint venture. Correct? These are companies that are operating in the foreign countries. So these companies here operating in the foreign countries are using the local currencies. Local currency. That is to say, it is not Kenya currency. It's not Kenyan currency, but local currency in which it's operating. Another name for local currency is what they call home currency. Correct? Another word for home currency, which we are now going to discuss about, is what they call functional currency. Functional currency. So these are the main terms that will be used when it comes to subsidiary company, associate company, and joint venture. Now, these three companies will be trading in that foreign country, buying and selling. Buying and selling. They are buying using different foreign currency, then they are selling using different foreign currency. By the end of the period, the foreign currencies have to be translated into functional currency, which means a functional currency here is a currency of primary transactions in the environment in which the entity is operating. So that is to say, it is not in Kenya, but in that country in which it is doing all the businesses. Then after that, after the functional currency has been determined, what will happen is that this functional currency here has to be translated into what we call presentation currency. That is to say, if these three are subsidiaries, associates, and joint venture of company A, then company A by the end of the year has to translate all these functional currencies into what? Into home currency, which is presentation currency. For example, assuming company A has this one, we have A here, we have B here, and we have C. And then maybe D here. So A is the parent company, B is a subsidiary, C is an associate, and D is a joint venture. For this case now, this is Kenya shillings. This is Tanzania shillings. This is Uganda shillings. And this is US dollars. You can see. So, if this one is in country B, and this one is in country C, and this one is in country A, D, it means that country A uses Tanzania currency. So therefore, this one becomes what? Home currency or a local currency or a functional currency. Then if Uganda shillings is in the country called C, then it means C, the local currency is Uganda currency. And if US dollars is in country D, then US dollars is the local what? Currency. So this one is what you call local currency, and we are using the correct term as functional what? Currency. By the end of the year, this country A here, because it is a parent company, has to translate all these three. Has to translate all these three into what? Presentation currency. And this presentation currency, it will be upon this particular company A to decide which presentation currency it wants to use. Remember, under IAS 21, there is no legal way of determining what kind of currency you want to present your financial statements. So you can decide. But in most cases, we normally use the common currency that is being used in that particular country. In this case, in Kenya, we use now Kenya shillings. But there is no law or there is no standard that is forcing you to present your currency in US dollars, and the company is in Kenya. There is no standard as per now. That is all what they call transaction. So let me first of all make some definition of specific terms before we move on. Now, before I do all this, what will happen here is that during the foreign transactions, you'll end up having either what we call foreign transactions. Here, we are talking about transactions at the time of delivery. Correct? We have the transactions taking place at the time of delivery, and we have also the payment period. Payment. So if, for example, you have bought goods today is 8th of September 2024, and then you make the payments 8th of October 2024. The currency, the exchange rate that prevailed at the time of transaction might be different from the exchange rate at the time of payment. And because there is a difference at the time, because there is a difference in terms of exchange rate at the time of transaction, and the exchange rate is also different from the time of payment, it will result to what we call exchange difference. Exchange what? Difference. Why? How does exchange difference occur? It occurs where the exchange rate at the time of transaction is different from the exchange rate at the time of payment or receipt. So this exchange difference here can either be a gain or a loss. Correct? And for us to get what we call a gain or a loss, we have to carry on what we call conversion. Remember, this transaction is not taking place, is not at the end of the period, but is during the year. Maybe in January, in February, in March, within the year. But by the end of the year, we don't talk of a conversion, but we are talking about translation. So therefore, get note here. I'm talking about financial reporting and analysis section, that is intermediate CASNET syllabus. For that case, in this case, there was a question that students were asked to explain how the transactions will, how the accounting treatment of a company that was operating in another country in Kenya. These are the 3 stages they wanted you to do. Number 1, you have to state that you must do what we call foreign transaction first. Correct? Then after trade transaction, translate that transaction into local or functional currency. From functional currency, you come now to translation. So therefore, for that matter, I'm very interested with the gain or loss. And we have said gain or loss arises where the exchange rate at the time of transaction is different from the exchange rate at the time of payment. Let's see an example. If you don't have these notes, kindly reach us on CPA Makan, CIPS College. Just search me in the YouTube, search CPA Makan, CIPS College, that is CIPS. And you'll be able to find us there. Ask for the notes if you don't have, and I will share the notes with you, and from there you'll be able to revise, and if there is any question, kindly reach us and we shall be able to assist you for that matter. Let's see the question on conversion. Correct? Yes. I've said on conversion process, you'll end up having what you call exchange difference. Let's see the conversion. Conversion here, you mark. What are you interested here? In conversion, you have to mark the date of transaction and the date of payment. The date of transaction and the date of payment. Now, I'm specifically handling CPA intermediate level, but under advanced level, you'll allow me to proceed further after this. But for your level, that is CPA level, intermediate level, you are only supposed to know the definition of terms, and maybe I've studied it carefully. I've not seen a question that relates to translating a subsidiary currency into the parent company. I've not seen such a question, meaning that your level for intermediate level is very shallow. You are only supposed to understand what is foreign exchange, correct? You have to know how it works. Then from there, you end up having a shallow definition and calculations here. So for those who are in CPA, if advanced level, allow me to proceed with you, but after finishing this level. Let's see the question. There is a question 1 there. It says, suppose a local company buys a large consignment of goods from a supplier in Germany. The order placed on 1st May and the agreed price is £124,250. At the date of delivery, the rate of foreign exchange was 3.5 or 3 shillings 50 cents pounds, 3.5 pounds to $1. When the local company comes to pay the supplier, it needs to obtain some foreign currency. By this time, the rate of exchange has altered to 3.55 pounds to $1. How would local company record the transactions in its books and determine gain or loss? This question seems to be hard, but very simple. First, understand when is the transaction. 2, when is the payment. 3, exchange rates. 3 points. Let's see. Suppose a local, this example 1. So we have example 1 here. Example 1. Suppose a local company buys a large consignment of goods from a supplier in Germany. The goods is placed on 1st of May and the agreed price is 124,250. This is now goods. We call it purchase. Purchases. How much? Pounds? 124,250. When the order was placed on 1st of May, what happened then? At the time of delivery, remember I covered the topic on revenue. At what time do we say there is a revenue? Do we say the revenue is on when you are placing the order, or the revenue, right? Revenue or payment or liability starts at the time you receive the goods. So we say under that IS 18, we say that revenue or payments or liability will come in when you are receiving the goods. So this 1st of May is just the date of making an order. But when was delivery? We have not been told any. So we can assume it is within the first month of May. So within the month of May. Then what was the exchange rate at this time? Exchange rate was pounds 3.50 to $1. This is the purchase order. This is order. Correct? Then what happened later? When the local company comes to pay the supplier payment, so we now say there was a payment. We don't know when they made the payment, but it's within the year. Payment. There was exchange rate. Exchange rate was now pounds 3.55 to $1. So when you look at this carefully, it is telling you that the exchange rate at the time of transaction is different from the exchange rate at the time of payment. Therefore, this one will give you what they call what? Exchange difference. And this exchange difference here can either be a gain or a loss. Correct. Question. How would local company record the transaction in its books and determine gain or loss? The first part is recording of transaction. So we only record the transaction. We only record the transaction by using the exchange rate at the time of receipt of an order. So in this case now, we can now say, okay, recording. So we can record this one by use of the rate that prevailed at the time of receipt. So in this case, this is the information. So the two accounts, purchases account and what? Payables account. So we can have say which one is debited and which one is debited. So we are debiting our purchases. So you say debit purchases account. Then you credit your payables account. At the time of, we are just recording. We have not made any payment. So we do recording. So recording is done at the time when the transaction was received. So at this time. So therefore, you can say for the payables is what is very important. Payables here. So in this case, we had 124,250. We divide this by 3.5. So if you divide that by 3.5, your answer you get is 35,500. Which means that the payables, the liability at the time of receipt is 35,500. Then we debit our purchases with 35,500. This is the recording. Now, for determination on gain or loss, that is what the question is saying. Determine gain or loss. Correct? Now, for us to determine gain or loss, we have to compare the payments we are making. For that matter, when we are making the payments, it means we are reducing our creditors and we are reducing also our bank. We are reducing our creditors and we are reducing also our bank. For that matter, I'm crediting my bank or a cash, then I'm debiting my creditors. So for that matter, I'm crediting my bank and I'm debiting my creditors. So I now say, okay, I have to debit my payables. How much is the payables? We have already this is your liability. That is 35,500. Correct? Then you are crediting what? Bank or a cash. Okay? So because I'm crediting bank or a cash, I have to say now, at the time of payment, what was the exchange rate? So I have to convert this to see how much is the liability that I'm paying. So I will now take 124,250 divide by 3.55. So if you do your calculation very well, your answer you get there is 35,000. So you can see, instead of you paying 35,500, you are paying 35,000 based on the exchange rate. Therefore, it means you are paying less than what is expected. So for that matter, you have an exchange gain, which means it is a benefit to you as a company. Gain of how much? For it to be complete, 500. The rule here is do not touch on any transaction recorded at the beginning. Do not interfere with this by saying, let me balance. You remove this one. No, you bring in what we call exchange difference. Exchange difference. So exchange difference in this case is a gain of how much? 500, so that it balances. So in this case, you now see the gain is 500. That is the first example. You can see how simple it is. The second example, suppose that another home company sells goods to a Chinese company. This is now sales, not purchases. So which means you are making sales, you have two accounts. that is trade receivables and sales. And it is agreed that payment should be made in Chinese yuan at a price of 116,000 yuan. We will further assume that the exchange rate at the time of sale is 10.75 yuan to $1. But when the debt is eventually paid, the rate has altered to 10.8 yuan to $1. Make journal entries and determine exchange gain or loss. Journal entries. Journal entries and the exchange loan. So our work will be very simple. Journal entries. This is example 2. First, mark the date of transaction. Mark the date of receipt. In this case, it is a cash sales receipt. Then mark the exchange rates. So in this case, journal entries will mean that you need to have the credit on this side, you have the debit on this side. That is what we call journal. Journal is like that. Then we have the date here. Then we have the description. When they talk about journal, it's like this. Recording is like this. So they are just the same. Only that debit is now arranged like that. So let's see. Let's record this transaction first. When was this transaction? Let's read the question again. Suppose that another home company sells goods to a Chinese company, and it is agreed that payment should be made in Chinese yuan at a price of 116,000 yuan. We will further assume that the exchange rate at the time of sale is 10.75 to $1. But when the debt is eventually paid, okay, there's a payment. So let's do recording first. In this case, we don't have the debt. So we don't have the debt. So we can assume there is no debt here. So what is happening here? We are doing the sales. So we have to debit our receivables. Correct? Then once you debit your receivables, you credit what? Sales. So because we are dealing with the receivables here, it will mean now how much was yuan? 116,000 yuan. You divide by how much was the exchange rate at the time of sale? 10.75. 10.75. How much is that when you divide it well? It will give you 10,800 what? This is in China. This is now should be this is a German case, so it should be in dollars. So this one is in dollars. In dollars. Now sales will also be the same, 10,800. This is recording. This is recording. So narrative. What is the narration here? Being the sale of goods on credit. The sale of goods on credit using what? Chinese yuan. That is your narration. Now let's see the payment. Now when we are making the payment, the exchange rate has changed. So if we are making the payments now, in this case it is the other company paying us. So we are debiting our bank. So you debit your bank. Then what are you crediting? Receivables. Receivables. Now the bank receivables here, the amount to be paid is how much? How much is 10,000? This is 10,800. So we want now to mark this. Let's see how much you are paying. Now you take 116,000. You divide by the exchange rate that is prevailing at the time of payment. That is 3.55. Now 3.55 will give you how much? 10,750. 10,750 dollars. Therefore, it means that we are receiving 10,750 instead of receiving 10,800. Have we lost as a company or we have gained? We have lost. See, we are being paid 7,750. This question is about purchases and this question is about the sales. So here, this sales, it means that we are receiving less. So therefore, it is a loss. So therefore, we now say the balancing figure there is 50 shillings. So this one is exchange. You now fix there and say exchange loss, exchange difference loss. So what is this? Being the payment in what? US, the seed of payment are in US dollars. That is how you are supposed to analyze those examples. Now, for that matter, let me just make some definition of terms. Definition of terms. Before I proceed with the examples. Now, when we talk about definition of terms, we have specific terms that are supposed to be understood clearly from the IAS 21. The first term is what they call foreign currency. The first term is foreign. The first term, is it foreign? Just a minute. Foreign currency, yes. Foreign currency. That is the first term. What is foreign currency? So foreign currency here, we mean this is the currency other than the functional currency. This is the currency other than functional currency. In simple terms, we are saying this is the currency in which the entity is using in the foreign country, in another country. That is what they call what? Foreign currency. Another term that is coming clear from here is functional currency. Now, when you talk about a functional currency, I've actually explained by saying this is the currency. This is a currency of a primary economic environment. A currency of a primary economic environment in which the entity is operating. So we are saying a currency of primary economic what? Primary economic environment in which entity operates. I want to explain that. So, functional currency is a currency of primary economic environment in which an entity operates. That is to say that this particular entity that is operating, maybe it's a subsidiary, a joint venture, or an associate in that particular foreign country. The currency that is operating in terms of selling goods, paying the expenses or incurring expenses, the currency that is using now is what they call what? Functional currency. And therefore we are saying, what is functional currency? Functional currency is a primary economic environment in which an entity operates. So when they talk about primary economic environment, primary means, in this case, primary economic means that this is the currency that is dominating the sales, the currency that is dominating expenses in that particular foreign currency is what they call primary, basic. So therefore, in this case, it means that you have to be very careful on how to determine the functional currency. How do we determine the functional currency? In this case, there are three factors. There are three factors to determine functional currency. There are three factors to determine the functional currency. How do you know that this is the currency that is actually prevailing in that particular element? Number one, you have to state, or Roman 1 for that matter, is the influence, currency influencing what? Sales price. The currency that is dominating the sales price will form what we call functional currency. Number two, you can also say number two for that matter, is the currency influencing operating costs. Operating costs, in this case, you are talking about labor cost. Correct? You're also talking about material cost and others. So the currency that is being used to pay the costs is what you call functional, will be used now to determine the functional what? Currency. The third one is what they call finances. Actually, here you have to be very careful. When you talk about finances here, I'm talking about debts and equity. The currency in which our debts is operating is what will determine the functional currency. The currency in which our equity is operating will determine our functional currency. Correct? Now, these are the three factors, these are the three main factors that will be used to determine the functional currency. Now, number 3 term is what we call an exchange difference. Exchange difference. Now, we have already mentioned here that exchange difference is where there is a difference between the exchange rate at the time of transaction and the exchange rate at the time of payment or receipt. So what is now exchange difference? Exchange difference is the difference resulting from, this is exchange difference resulting from exchanging units of one currency to another currency. Exchange difference, the difference resulting from exchange units of one currency to another currency. That is what we call exchange difference. On this note, we can also say exchange rate. Exchange rate. When we talk about exchange rate here, we are just talking about ratio. Ratio of currencies. Ratio of two different what? Currencies. Ratio of two different currencies. We can see example here. We can see example here saying that 3.5 pounds to $1. We have also another one here, 3.5 pounds to $1. This is what we call the ratio. See, they are in this ratio here. Sorry. They are in this ratio, 3.55 to 1, which means 3.5 units of pounds to $1, to 1 unit of dollar. This is what they call exchange rate. We have also what they call spot rate. Now, when we talk about a spot rate here, it is very important to understand this. Spot rate here means, immediate exchange of immediate delivery. Yes, that rate that prevails immediately at the time of delivery is what you call what? Spot rate. Is what you call spot rate. Now, what about closing rate? What about closing rate? When we talk about a closing rate, we are talking about the rate prevails at the very end of statement of financial position. This is the rate at very end of statement of financial position, or date at the balance sheet date at the close of balancing date. That exchange rate at the end of balancing date, closing date, is what they call what? Exchange rate. In most cases in Kenya, most of the companies prepare their financial statements as at 31st of December every year. So the rate that prevails as at 31st of December every year is what they call closing rate. Now, that is very important. Very, very, very important, that I would like you to understand. Now, we want now to go to what they call recognition. want to go to recognition. Yes, let's see recognition. Recognition of foreign currency transactions. Very important. Very, very, very important. Now, when you talk about recognition in this case, we are just talking about incorporation of foreign currencies in our financial statements. Incorporation or inclusion of financial statements of foreign currency into our financial what? At what time should we recognize now foreign currencies in our financial statement? So there are two ways, there are two recognition stages. Stage one is what we call initial recognition. Initial recognition. When you are referring to initial recognition, we are talking about first. The meaning of the word initial is what we call first. 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 So immediately you do the transaction. Here it means that how do we recognize the transaction in our financial statement, this foreign currency? This is where you are saying this is the first recognition. So the first recognition in our books of accounts states that you recognize this one using the foreign, using the functional currency. Functional currency using the rate at the time of transaction. That immediately you buy or you sell the goods, you are supposed to recognize financial currency in your books of accounts using the rate that prevails at that particular time. Correct? That is very important. Now, for that matter, if, for example, there is slight difference, if there is what you call a slight difference in terms of exchange rate, that is from January to December, you are allowed to use average rate. If the disparity between the exchange rate in the first month, second month to December is very small, you can use what you call the average rate. Now, what about subsequent recognition? This is now very important. This is now immediately you have done your transaction, recognize the functional currency using the exchange rate that prevails at that particular time. What about thereafter, meaning the following year now, after you have done this transaction? Remember, not all the goods that you have bought would have been sold by the end of the year. So we shall be having some of the goods remaining. And not all the liabilities have been paid by the end of the year. Part of the liabilities would be remaining. So how do you recognize this that after? It's what we call subsequent recognition. Now, on subsequent recognition, it depends on specific elements. Subsequent recognition depends on the specific element. Number one, for you to recognize now the foreign currency into the financial statement, you must be able to report foreign currency transaction, monetary items using what? Using what? Average rate. Using the average rate or a closing rate. Using closing rate. I want you to understand the meaning of the word monetary. And get note of this carefully. So in this case, you are saying report foreign currency transaction monetary items using the closing rate. We have said a closing rate is the rate that prevails at the very end of the financial year of that particular company. That rate that prevails at that time is what you call closing rate. Now, we have what you call monetary items. When you talk about monetary items, we are referring to those items that can easily be sold or can easily be translated into cash. So these are easily, when you talk about monetary items means easily sold, is easily translated into cash, e.g. receivables, payables can easily be translated into cash, loans. Now, why not stock or inventory? Why not property, plant, and equipment? Stock, you have not found the customer, so they are still in your store. So because you have not found your customer, it cannot easily be translated into cash. You have to look for the customer first, then convert into receivable. But this receivables here means already customer is using the goods. For that matter, you can receive this money anytime. Payables here means you have already received goods on credit. So therefore, you can easily pay. Here, when you talk about loans, it means you have already received. The bank has already given you money. So they are already easily translated. But stock, no. Stock now will follow what they call non-monetary items. Now, how do you recognize subsequently again? Report, this one is report foreign currency transactions, non-monetary items using non-monetary items carried. This one will be different now. Items carried at its cost using what? Historical rate. I want you to understand these terms here. Using historical rate, and then non-monetary items. First, we can now say non-monetary items means not easily translated into cash, e.g. property, plant, and equipment, correct? Inventory or stock, inventory, comma, intangible assets, inventory, intangible assets, and these are examples. Why? Because this property, plant, and equipment, you have to look for the customer first. You have to convert this into receivables first. So it will take time. That is why it is called what? Non-monetary items. Now, when you talk about historical rates, these are rates at the time of purchase. So it means convert or recognize these non-monetary items using historical dates. So when you have now see the PPE or inventory or you see the intangible, convert this one using the rate that prevails at the time of purchase. Then number three is that report foreign currency transactions, non-monetary items carried on fair value. Use what? Use rate at the time of measurement. Let me use the word remeasurement. measurement. When you talk about the fair value here, we are talking about the present value of an asset or liability at that particular time. That is to say, it is the price in which an asset can be sold, and the time is the price at which the liability can be settled at that time. It's what they call the fair value. Now, you use now the rate that is prevailing at that time of measurement. Okay? If you are doing revaluation, you can now use that rate. Now, let's see examples. I have two examples to elaborate on the same. Then we finalize the intermediate level. So let's see example. There is example there. Example number 4 says, White Cliffs Company, whose year end is 31st December, buys some goods from Rinca SA of France on 30th September. The invoice value is £40,000 and is due for settlement in equal installments on 30th November and 31st January. The exchange rate moved as follows. The exchange rate moved as follows. 30th September. Exchange rate now is in pounds, is equals to $1. 30th September. So this one is 1.6. Then we have 30th November. We have 1.8. Then we have 31st December. We have 1.9. And then we have 31st January. 1.85. These are exchange rates that are given now. So we have been told, White Company, let me read the question to the end, state the accounting entries in the books of White Cliffs Limited. Accounting entries. So they just want you to make the entries here. First, mark the date of transaction, the date of payments. Let's read the question carefully. White Cliffs Company, whose year end is 31st December. That is the financial year. So the financial year of the company is 31st of December every year. That is the time they close all the books and report. Very important. The reason why you are told that is for you to mark and see when are we closing the books. We are closing the books here. So therefore, this is another financial year. The payment is taking place in November and the 31st of this January. 20X. That the following year, you can see. So let's see. The very important is that. Then buy some goods from Rinca. Buys, that is purchases now. Which means there are purchases taking place here. Or from Rinca SA of France on 30th September. So there were purchases of goods on 30th of September. So the prevailing rate is 1.6 pounds against $1. Then what happens? The invoice value is this one. So the purchases. So you can now say purchases for that matter is equals to pounds 40,000. When? 30th of September. Very important. So state the accounting entries in the books of White. So you can use any. For that matter, your work will be very simple. You just now say, okay, I have the date here. We have the description here. Then I can have a debit here and credit there. So it should be in what? So I'm translating this one to dollars. Like that. So we can have something like this taking place. So we can now say, yes, on 30th September, there is recording that is taking place. We are buying goods. So therefore, it means we debit our purchases. Then we credit our payables. So payables, we are buying these goods on credit. So we are buying how much? 40,000. You divide by, what was the exchange rate at the time of that particular time? 1.6. So you divide by 1.6. How much is that figure? How much is that figure? It will be 25,000 here. So then you debit also 25 what? 1,000 there. 25,000. Then you have finished recording. This is just recording. So we have recorded this one in the books of accounts. Then what is the question saying? The question is saying the invoice then set is due for settlement in two installments on 30th September, this one here, and 31st January, this one here. So we are making the payments on that date. So equal installment, meaning that out of this 40,000 here, each installment is now 2020. We'll pay the first 20 on 30th November. On 30th November, we will pay 20,000 pounds. This one. So we debit what there? So we debit our purchases. Then we credit our bank. Or you can say cash. Okay? We are crediting bank. So 20,000 first installment. So you take now 20. You divide by the rate that prevails on 30th of November, which is 1.8. 1.8. So how much is that? If you do your calculation very well using calculator, your answer you get is 11,111. 11,111. Now, this is first installment. How much was the total payable? 40,000. 40,000, this one. We have translated 40,000 pounds into dollars. This. So how much is half of this? 12,000? Half of this is per year now. Here you put now a half. 12,500. Is it correct? First payment. First payment on 30 November, 12,500. You divide this one by 2. Once you are through, you look at it now. You can see what we are paying. We are paying 11,100 instead of paying 12,000. Is it a benefit to us or a loss to us? It is a benefit. Therefore, we call this exchange. So we add that, say exchange gain. How much is the exchange gain there now? 1389. 1389. So we have saved 1,389 when we make the payments on 30th of November 20x. Now, look at what is happening. The next payment is the following year. But the following year, what will happen on 31st of December when we are closing the books now? December. When we are closing the books on 31st December, there is something that is taking place there. Correct? There is nothing that is taking place in December. For that case, this December here, there is nothing that is taking place there. What we do is that we do what we call remeasurement. We have to remeasure the liability using the exchange rate at that particular time. Remeasure the liability at the time of closing the books of accounts. That is by use of, not 18, sorry, this one here, 1.9. So our work will be very simple. Now, how much is remaining? How much is the liability remaining? We have already paid 12,500 out of 25,000. How much is remaining? How much is remaining? Now, forget about that. Let's go to the pounds. How much is the pounds remaining? We have paid 20,000. How much is remaining? 20,000. So you can now say, okay, what is remaining? The liability is 20,000. Translate this one using the exchange rate at that time, which is 1.9. Will give you how much if you translate that? 10,526. So this is the translation. If I translate this liability that is remaining at this time, which is 20,000 pounds, I translate it to dollars, it will be 10,526. Now, the question here is, because there is no payment taking place on 31st of December, what you do is very simple. Now, check. Look at this and compare this and the liability here. This is the liability. But this is what? This is the liability when we are paid. This is what it is. So how much is the exchange? You can see that if I was to pay on 31st of December, I will pay 10,500. But because I'm not paying, I have to compare with the previous remaining, which is the amount remaining is 12,500 from here. So I compare the two. What is the exchange difference? Exchange difference is how much? I will take now 12,500 minus 10,526. My answer is how much? 4,000. I will get 4,000. So not 4,000, but 1,974. 1,974. This is now the. Now compare. If I was to pay, I cannot pay 12,500, but I will pay 10,526. So it is a benefit to me. So for that case, because it's a benefit, I have to reduce the payables, debit payables. I'm reducing payables, then exchange gain. So I will debit now. This one is for 1,974. Then this one is 1,974. The reason why I'm not saying debit this one is because this date here, there is nothing that is there. I just want to see whether there is a gain or a loss. So I've discovered that if it is the payment, I'm supposed to pay 10,526. But because there was no payment, it will just be a liability. Compare with the how much is remaining from 25,000. 25,000 divided by 2, you get 12,500 carried forward to the following year, which need to be paid on 31st of December. So 31st of January. Now, on 31st of January, we are supposed now to pay how much? To pay how much? 20,000. By use of what rate? 1.9. So we have to pay that amount by use of 1.9. So I will now say payment. So you now say, what are you debiting? You debit, I debit my payables. I debit my payables. Then I credit my bank. So the payables for that matter I'm paying is how much? How much am I paying? Is it this or this? I've already translated this, therefore this is my figure here. So I'm paying, payables is reading 10,526. How much am I paying as a bank? I will take the remaining balance, 20,000, you divide by the exchange rate prevailing at the time of payment, that is 1.85. It will give me 10,811. 10,811. 10,811. Now, I check. This is what I'm paying, and this is what I was supposed to pay. Am I paying more or less? I'm paying more. Therefore, it means it's a loss to me. So therefore, that loss here, it needs to be balanced here. So it's now say exchange loss of how much? Exchange loss of how much? 285. 285. So exchange rate of 285 is a loss. 285 is our loss. Now, that is how you are supposed to. Now, NB. Exchange rate for that matter will be recognized in our financial statement under other comprehensive income. Recognize exchange difference in the other comprehensive income. You remember there is a format of preparing statement of profit or a loss and other comprehensive income. So profit or a loss and statement of profit or loss and other comprehensive income, there is a format. So that exchange rate, which in this case it will be now, e.g., there was a gain first. There is a gain here of 13,800 and net plus another gain. There was another gain of how much? 1974, but there is a loss of how much? 285. So the final answer you get here is what now you put it under other comprehensive income. Now, NB, another NB. 1. Translate all assets and liabilities in the statement of financial position using closing rate, except, very important, except what? Except equity and retained earnings. Except equity and retained earnings. Equity, I mean share capital, and retained earnings, the profits. So in this case, translate all the assets and liabilities in the statement of financial position, but do not touch on this. Then the question is, how do we get it? How do you get these two? Now, once you have now the total assets there up, then you will skip the equity and the retained earnings, go to liabilities like long-term debts, current liabilities. The balancing figure there, the balancing figure now will be treated as equity and retained what? Earnings, the balancing figure. Very important. Another element, number 2. Translate all the incomes and expenses in the statement of profit, loss, and other comprehensive incomes. Statement of profit or loss and other comprehensive incomes using what? Average rate. Using average rate. So for intermediate financial reporting and analysis, that is the far you are supposed to cover. So therefore, for the advanced financial reporting, we need to go further from here to now consolidation. But because this is actually for financial and intermediate level, I don't want to introduce the consolidation because we have to cover consolidation first. For their syllabus, they're not supposed to go to consolidation using the exchange rate. But for advanced level, that is advanced financial reporting, they are supposed to go further to that. So thank you so much for giving me an opportunity to present on IS 21 and on under foreign currency transactions. Welcome.